Hey everyone, my name's Andy. My channel is Finding Value. If you like this content, please subscribe, please comment, and please do the thumbs up button. Keep commenting. That's what I'm going to tell everyone. I'm refining some of these presentations because of the comments that all of you leave, which will hopefully, one, it forces me to present better and put together a different approach for you guys to understand it. And two, you guys are going to learn quite a bit. I suggest to learn as much as you possibly can before this commodities bull market really takes off. We are right at the beginning of this bull market, and now is the time to be loading up on all of these shares for investments. I'm going to go over a clip. It's called "What Drives Markets," and I don't think I've ever really seen this anywhere. So a lot of this stuff is all self-developed from me and off the top of my head, based off of many years of research. So this is going to be a cool clip. I think it's going to be a lot easier to understand. And it's going to tie a couple of things together that people were asking me to tie together. So here I'm going to try to visually show it and talk about it and give you guys examples. So this is going to be a good one as well. I think it's going to be very value added. So what drives markets? So demographics is what drives markets on a lot of things. Demographics is what drives, we'll call it aggregate demand. This drives inflation or deflation. And when people think of Japan, they've had terminal deflation, and you can hear that from a lot of people. Japan, deflation. The reason is their demographics. Their housing market is way down. The housing market and demographics is what drives inflation and deflation. This also drives long-term interest rates in that currency. And you can tell by Japan having a demographic that is declining. Their population's actually declining. Their interest rates have been going down. Their house prices have been going down. They've had deflation. Now, in America, we have a dip. There's a dip between baby boomers and millennials. Gen X is a smaller amount of population or group than baby boomers and millennials. That is where we got this big decline from 1980 till today in interest rates because of that decline in population. I'll show you in the next slide what that looks like. Millennials are coming, and they're a larger population. They are going to drive inflation higher because of this larger group of demographics. And here's the chart. This is what the demographics look like. The baby boomers are right here. That is this age group up here. And see how it declined in population here to Gen X? This decline right here is why interest rates went down, why house prices really didn't shoot very high. And why inflation wasn't that big of a deal over this long period of time. Now what's coming is the millennials, which is a much larger group of population, they're coming. And they're coming at the same time that we've got a screwed up housing market from the early to mid 2000s. So the demographics here is going to support an inflationary environment. Now, we talk about inflation and deflation. Inflation is just, it's the supply of money. It is money supply growth. The drivers of inflation are the real estate market and demographics. It's those two things combined. Demographics is the ultimate driver, but the real estate market has to go up in price, and more money has to be loaned into existence from commercial banks on top of the demographics. So fractional reserve lending, that's what we have as a money system, expands the money supply from commercial banks through the loans into residential real estate onto a demographic that is larger. So the Federal Reserve prints money and it goes into the commercial banks and sits there on their books, so to speak. If it doesn't get loaned into existence, it just sits there and the velocity is low. it doesn't actually get into the hands of people where inflation can happen. It just sits on the bank's books. So money needs to be created into existence through loans and higher prices into residential real estate or real estate. Home prices going higher gets more money into the hands of people because more people are going to take larger and larger loans. And if you know fractional reserve banking, if you guys can look this up online if you want to, commercial banks can expand the money supply up to 10 times from their reserves. So if they have a $100 reserve, they can expand it up to 1,000 using a 10% reserve ratio. So that's where the majority of the money is created in our fractional reserve banking system, is from them loaning money into existence. They are literally creating money. Watch the market indicators for real estate for your answers if real estate is going higher and that we're going to have more and more loans coming into existence. We look at inventory, days on the market, interest rates, foreclosures, prices, and there's some other small metrics that we also look at. But that's going to tell us if house prices are going higher. And right now, those metrics are all absolutely screaming that house prices are going to go higher. So I'm going to go into housing starts. And what I'm going to touch on here is how messed up it is. So I took the Fred housing starts, and what I did is 1.5 million-ish is about the demand, yearly demand. That's about what we have to create every single year to have the housing market stay in balance. This is the red line that's going across here. Now what I did is I highlighted what's below it in yellow, and I highlighted what's above it in red. And what has to happen over time is you're looking at housing starts. This is the cycle. This is a recession, recovery phase, expansion, and then a hypersupply happens up here, and then it goes back into recession. Then we go back into a recovery phase, an expansion phase, and then a recession. And this is the housing market cycle that we're looking at right here through housing starts. Now, the one thing to understand here is the yellow underneath this line, the area under the curve, has to equal the area under the curve above the line. That is what keeps the housing market in balance, is that area under the curve and area over this line of 1.5 million housing starts per year, because that's what the demand is. If you look, we had a lot more yellow here than we did red before this. This created a large spike. So what this means is that we were underbuilt in 1970, and we had the demographic come, which really blew inflation through the doors over here. And that was from 70 to 80 because the demographic came in and wanted to buy homes all through this 70 to 80 period. And we started this period with an underbuilt scenario. We needed more homes, and the demographic came, which really piled on the inflation. Now, if you look on the right-hand side, we were in a hyper-supply phase here. We built too many homes, and the government backed a bunch of mortgages. They just all had these all days. They had a bunch of subprime mortgages, and they really screwed up the housing market by those government-backed loans. They really messed it up. So what you're seeing here is you're seeing this massive problem of undersupply. That's what this yellow is under here. And what's happening is we've got a demographic, just like the 1970s with the baby boomers, we have a demographic of the millennials coming. And we've got this alignment where housing starts are massively underbuilt. And we can see that in this housing starts with the area under the curve here. And we're going to have to go far over this curve right here, this line. This curve is going to have to go way up, and we're going to have to build a lot more homes because we're underbuilt, and on top of it because of the demographics. The 1.5 million is probably going to be a little bit higher than this, than historical standards. So the housing market, in terms of new housing starts, is messed up in the residential section. So the housing market's in worse off shape than any time in history, with a 4 million home shortfall or deficit. The demographics of the millennials are coming. which are going to drive demand for homes at the same time we're recovering from a government loan debacle, which led to a massive 4 million home deficit. That right there is setting the conditions, everyone. I mean, it's going to be huge. Interest rates will, I quote, chase inflation higher. That's what puts or keeps everything in balance. It tries to slow the money down. Interest rates is a reflection of the demand for money. And when you have a larger demographic in a higher home price environment, the demand for loans is going to go up a lot higher because we have a shortage of homes. So interest rates go higher to kind of slow down this demand for loans. When interest rates go higher, and that's why I call they chase the housing market or home prices higher, because of the demand for loans is going to just increase exponentially here. It's going to put pressure on stocks and bonds because of the discount rate interest rates put on stocks. And when I mean by stocks, I just mean regular retail stocks, tech stocks, not commodities. The risk-free rate on bonds will be higher, pushing old lower rate bonds down to equal cash flows of one another, to equal those net present values. So if you have a bond that pays a lower interest rate and a new bond comes out and it's twice the interest rate, why the heck would you buy the old bond at a lower interest rate that still has some payout? What they're going to do is they're going to equal the net present value, which means that the lower interest rate is going to have to go way down in price to equal the new bond and their higher payout. That's how this stuff works. Interest rates are a reflection of demographics and housing market balance. That is what it is. And that's why Japan has had super low interest rates and a deflation, is because housing market is going down in Japan and their demographics their population is declining. We're not in that same situation, so people who are making that comparison aren't looking at the demographics and the housing market balance. That's where they have it wrong. So here's interest rates. The long-term interest rates are from demographics. That's what really drives the inflation deflation. We had that gap in population, and that's why this has declined all the way back down to zero. So it's these gaps that are creating. Now, some of it was forced down. It's artificial, so to speak. It's man-made that are pushing some of this stuff around. Now here's the 10-year treasury. This is a yield. What you're seeing here is it bottomed out. And this, if you know how to read charts, and I do, the momentum's changing from this point on. Big up day, small pullback, big up day, small pullback. And this is just a signature that interest rates are going to go higher. Here's the catch though, all right? The government, the Federal Reserve, is going to try to keep this down. They're going to have to buy a butt ton of bonds, and I don't know if they can do it because the bond market is very large and they're going to have to create insane amounts of money to try to hold this thing down. Now, when you have inflation, if your inflation is much higher than your 10-year yield, what you get is you get a negative yield. It's called a negative real yield, and a negative real yield is absolute fire to precious metals and commodities. If they're successful at holding this 10-year down, you're going to get larger and larger negative real yields. If you get larger and larger negative real yields, precious metals and commodities are absolutely going to blow the doors off any other investment, and they are going to rocket. It's going to be insane because this is on a worldwide basis. This just isn't America. And the entire world is participating in this. So we've got commodities here. We have a rare alignment, which is going to be insane for investors. We've got demographics or population that's increasing in the United States. Remember, we're the reserve currency. We have a housing market that's underbuilt by 4 million homes. We have interest rates that are at rock bottom because of COVID and demographics. COVID exacerbated the move to the downside in terms of yields and in terms of commodity prices and producers. The USA's reserve currency is going to be tested here when we have all of this inflation. This is a worldwide issue. This isn't just confined to the United States. So this means everyone's going to participate in this commodities bull market, and the ramifications of any peak production is going to be on a worldwide basis. So this is going to be bigger than everything else. We are hitting peak extraction rates for some metals. We should probably be owning those metals. We're probably going to hit peak oil in the next 10 years. That is going to be huge, and it's going to be fire for this commodities bull market. And hopefully it's not a complete detrimental effect to human population. And commodities have never been this cheap in 100 years. This is a ultra rare scenario here where all of this is aligning. And here's the valuation. This is 100 years of commodity valuations. We're way down here. And you can see we're scraping the bottom in terms of commodity valuations in relationship to Dow Jones ratio. We are absolutely cheap. And you could see the same scenario happened in the 30s. This was the Depression. Remember, in the 20s, that was another demographics, and this was every single market crash. Before the crash, it's a leveraging up it's a big leveraging up. More people are taking loans. On the backside, it's a deleveraging. That money is being destroyed on the backside. Things are collapsing. People are defaulting on loans and all that, and that's where you get the deflation. Demographics also tie into this. So this is the same chart, just with the circles to make it show you and kind of what the average is. So commodities are extremely cheap in relationship to the S&P 500, very rare. So the conclusion here, play the long game. Don't be trading in and out. Buy these things and hold on. This is a rare opportunity, which is absolutely going to change your life if you can invest in these things. You want to position into commodities that will benefit from this ultra rare scenario. The overall stock market and bonds, I think, will be poo-poo because of market conditions and especially in comparison to commodities. Some technology companies will prosper very heavily if we run into an energy constrained world. We're going to be doing things a lot more through there's going to be a premium on moving things. So if you don't have to move things, if you can do things through technology, if you can do it working from home, those are obviously going to prosper going forward, I think. Commodities and precious metals will go insanely higher, probably numbers that I cannot fathom and that you don't even want to fathom. You will probably be in disbelief because we haven't seen, everyone that's living right now has not seen these types of conditions in their life, outside of maybe some older baby boomers that are 70, 80, 90 years old. Those are the only people who've seen the 1970s and grew up through it. Everyone else has been in this declining interest rate environment, low inflation, well, relatively low inflation compared to what's coming. So we need to get prepared. We need to lock in interest rates in your mortgage. We need to, you better have a house because it's prices of homes are going to go up. Prices of rents are going to go up. We're going to see a large demand for homes. We're going to see massive inventory draws on homes because we just don't have the housing inventory there, which is going to push prices a lot higher, in my opinion. It's going to push interest rates higher. You're going to see the stock market not do very well. You're going to see commodities absolutely moonshot. It's going to be the biggest commodities bull market that anyone's ever going to see, probably in anyone's lifetime. That's my opinion. If you guys like this content, please subscribe, please thumbs up button. I like doing these clips. Thank you for your comments and have a nice day.